Question number 2. Smriti or Vignesh or Hemant, Nikhilesh, anybody, Karthikeyan, anybody, please read out question number 2.
Students, can anyone read the question?
Yeah. Based on the credit rating of the bonds, Mr. Alok has decided to apply the following discount rates. Credit rating and discount rate. If credit rating AAA, discount rate is 364 days, T-bill rate plus 3% spread. If credit rating is AA, discount rate is AAA plus 2% of spread. If credit rating is A, discount rate is AAA plus 3% of spread. He is considering to invest in AA rated, that is a 1000 face value bond, currently selling at 1025.86. The bond has 5 years to maturity and coupon rate on the bond is 15% per annum, payable annually. The next interest payment is due 1 year from today and the bond is redeemable at par. Assume the 364-day T-bill rate to be 9%. You are required to calculate the intrinsic value of the bond for Mr. Alok. Should he invest in bond, calculate the current yield and the yield to maturity of the bond.
Right. Okay. So the question is about three items. Okay, whenever we read a question, we should read the requirement carefully. The question is calculate the intrinsic value. Then, should he invest? Calculate the current yield, 3, and yield to maturity 4. In fact, I said 3, in fact, it is 4. There are 4 questions that you have. Mr. Alok is considering to invest in AAA rated 1000 rupees face value and which is available in the market at 1025.86. The bond has got 5 years period and coupon rate of 15% payable annually. The next interest rate is due 1 year later. That means at present the price is X interest. What do you mean by X interest? Exclusive of interest. Now we are expected to answer for the first part of the question. What is the intrinsic value? And for this purpose, for AA rated, looking into the rating, for AA it is AAA plus 2% spread. AAA for which 364 T-bill rate is 9%. Right? This is 9%.
Yes.
Plus 3, which is equal to 12. Now, for when it is 12% here, it is 12 plus 2, 14%. Please understand that coupon rate is 15%. We are expected to take up the discount rate, which is 14%. Now, like in the case of capital budgeting problems, how we normally do, that is the way we will try out. So here 1 to 5 and 5. The events are coupon and lastly redemption value. The cash flows are 150, 15% on 1000. Unless otherwise stated, face value is the redemption value. The PV factor should be 14%. How come it is 14%? T-bill is 9%, then 3, 12, and AA is 12 plus 2, 14%. Now, PV factor or annuity factor, as the case may be, we all know that price of the bond is simply the sum of the present value of future cash flows. 1 divided by 1.14, 1, 2, 3, 4, 5. So at this stage it is 0.5194. The grand total of that is 3.4331. What is the price? 150 into 514.97 and 1000 multiplied by 0.5194. 519. Grand total of that comes to, first part of the question they asked, what is, calculate the intrinsic value. Intrinsic value is 1034.37. Simple. Whatever at the intermediate level in capital budgeting, what we have done. Same thing is extended here. Next question, should we invest in the bond? You have to say yes or no. How to say yes or no? Actual price is lesser than the intrinsic value. Actual price is 1025.86. It is less than 1034.37. If the market analyst says that the worth of the share is 1034.37, when it is available in the market at 1025.86, we will say it is a scenario of underpricing. It is a scenario of underpricing. It is a scenario of underpricing. Therefore, strategy is to buy. Strategy is to buy. Out of 4 questions, we have knocked out. What is the current yield? Do we have any formula for that? Answer to that question is yes. Current yield formula is coupon divided by actual price. Coupon is 150. Actual price is 1025.86. Let's take the calculator and work out 150 divided by 1025.86 in percentage. That comes to 14.62%. That is the third question. Current yield, the formula is coupon divided by price. Fourth one, yield to maturity. Yield to maturity is nothing but IRR. What in the case of capital budgeting, it is internal rate of return. Here we call that as yield to maturity. So there are 2 different ways of approach that we have. One is approximate approach, then the other one being accurate. So whenever you have more than one, students will normally be asking the question, when to use which one? People will normally be getting confused when you say more than one number. So therefore, I want to bring out clarity. I want to remove confusion. What is that? Approximate method, please use. If yield to maturity is the only item asked, in the sense, if yield to maturity is the only question that you ask, here this is the 4th question. I am not talking about whether you have 1 question or 4 question. The matter what I am conveying is, if yield to maturity is the ultimate question, if yield to maturity is given along with other questions where yield to maturity is to be used as an input for other parts of the question, then accurate method should be used. The reason is that we all know ego approach, garbage in, garbage out. In system study, we used to tell like that. If the input and output will also be not accurate. There are problems where we have yield to maturity will be an input for questions related to duration and volatility. For problems involving finding out yield to maturity alongside of accurate method. If they ask yield to maturity as the only question amongst many where yield to maturity has got no further usage, then use approximate method. But I take the opportunity of discussing both. Under examination condition, for this problem, use approximate method only. Please don't use accurate method. I hope that I just made the point clear. For approximate method, the formula is coupon after tax plus redemption value minus issue price divided by n divided by 2. Let's go by this basic formula. Coupon after tax. The coupon, there is no taxation involved, plus redemption value. Unless we are provided clearly about the redemption value, we will normally take redemption value as the face value only. Let us check out value. We don't find any redemption value given separately. Therefore, the face value of 1000 will be taken up as redemption value. And the issue price, what they given is 1025.86. What actually the price an investor will pay, that is the issue price. And we are not supposed to use in such occasions the intrinsic value of 1034.37. Therefore, people might always have a doubt as whether I have to use actual price or intrinsic value. It is only the actual price to be taken. Divide that by 5. The whole divided by 1025.86 plus 1000, the whole divided by 2. The logic is a very simple logic. This 150 is going to be on per annum basis every year, and 1000 minus 1025.86. This difference is nothing but amortization. What do you mean by amortization? There is always a chance that redemption might be greater than the issue price. The extra sum that they got to pay has got to be spread across the term. In this problem, this amortization is in a negative. Never mind whether it is positive or negative. Let us just take up 1025.86. It has got to be deducted from 1000, which may result in 25.86 negative divided by 5. That will result in negative 5.72, with which 150 when you add, it comes to 144.83. The whole divided by 1025.86 plus 1000 divided by 2, that comes to 1012.90. So 144.83 divided by 1012.90. If you try that, which when it comes for percentage application, it comes to 14.12%. So this is the way we are expected to complete this yield to maturity. But it is not under examination conditions where in a classroom I got to explore the possibilities that accurate method is also a possibility for which I should give room for that also. So therefore, I would like to pick up something on accurate method. How do we do that? Let's watch. In accurate method, I would like to discount at 14% and at 14%. What is the price at which it will come? I know that at 14%, it is 1034.37. Right? I know pretty well at 15%, it is going to be 1000. How come? We all know the basic rules that we were taught in the very first class. If the yield rate and the coupon rate are same, then the price of the bond and the face value of the bond will be same. This in the very first class was taught. If the discounting rate, that being yield rate, is lesser than the coupon rate, face value, that is what we have seen. 14% is the discount rate, coupon rate is 15%. That is the reason as why the price is greater than the face value. Now, if I want to find out at what rate I would get the discounted value or discounted cash flow to match with the price, then I can say very well that the yield is falling between 14 and 14%. Therefore, I use this interpolation as the base. At 14%, it is 1034.37, and at 15%, it is 1000. So, in between 1025.86, where it is lying. So, I would like to just take up that computation. How do we do that? It is 14 plus 1034.37 minus 1025.86, the whole divided by 1034.37 minus 1000 into 15 minus 40. 1034.37 minus 1025.86. 8.51 divided by 34.37. I just give the answer as 14.25%. Approximate method is 14.12. Accurate method is 14.25. For this problem, this itself is sufficient. In the problem where to be that yield to maturity is used as an input, definitely we require this yield to maturity to be computed on accurate basis. So accurate basis yield to maturity is 14.25. With this, solution 2, question number 2 is over. Now I will stop sharing this and I take up on to PPT. Okay, the question in which in this PPT you are just getting 14.23 because the workings are all with 3 decimal working on, whereas we have just done with 4 decimal working. That approximation error will always be there. Then let us take up question number 3. Who will read out? If you have any difficulty in understanding the solution to question number 2, you may raise now your doubts. Come on. Anybody having any doubt in question number 2?
No, sir.
No. Right. Okay. Now, one of you please read question number 3. Small question only, please.
ABC Limited recently issued 15 years bonds. The bonds have a coupon rate of 7.5% and pays interest semi-annually. The bonds are callable in 5 years at a call price equal to 13% premium to par value. The par value of the bonds is 1000. If the yield to maturity is 6%, what is the price of bond today and what is yield to call?
Right. Okay, what do you mean by yield to maturity? Just now I was just talking about yield to maturity is synonymous to IRR. Meaning you would assign for IRR, same meaning should be assigned for yield to maturity. When the yield to call, by chance, if a company finds that the existing rate of coupon is costlier, how coupon could be costlier? 3 years back, let us assume that a company had issued a bond. Then there was a requirement of money. They have issued the bond. The CFO knew by then the money market was a little tight. Therefore, he prepared to issue bond at the prevailing market rate, and he also felt that in the times to come, the money market will be having smooth cash flow. That point of time, the rate of interest might even fall down. Since entities will commit for a future period of say 7-8 years, the same rate of interest would mean when the money market is having no problem, where the interest rates have fallen just because the company had borrowed under a tighter situation. If they continue to pay higher rate of interest, then it becomes loss because others will be paying lower rate of interest, whereas this company borrowed at a higher rate, they will continue to pay the high rate of interest. This sort of problem a CFO should foresee and include as part of the covenants with the bondholders that in the years to come, say after 2-3 years of issue, the company could recall the costlier bond and substitute with lower coupon bond. So this is considered to be a very smart move by the CFO. But there is a problem related to that. What is that? The new bond, even though may have lesser amount of coupon rate, but we may have to incur some expenses, issue related expenses we have got to incur. And not only that, the earlier bond which was issued at a costlier rate has got to be repaid at a rate greater than originally contracted rate. This we call it out as premium on call. These sort of expenses that they have to incur upfront, and only then they will be deriving benefit of paying lower rate of interest. Therefore, such a bond which has got this callable quality, for them, we do not refer to that as yield to maturity because our maturity period is truncated and it is advanced a little earlier or substantially earlier. So instead of calling that as yield to call, it would be better to call that as yield to call rather than calling it out as yield to maturity. We might even rename or rephrase it as yield to call. This is the value. Now, ABC Limited issued 15-year bond. The bonds have a coupon rate of 7.5%, paying semi-annually. That means in a year 2 times. In 15 years period, 30 times payment will be made. The bond are callable in 5 years at a call price equivalent to 13% premium to par value. That means when you break the contract, the person who is breaking the contract has got to pay penalty, which you call it out as premium. That means if it were to be 1,000 rupees bond, you may have to pay 13% more than the face value of the bond. 1,130 is the sum that you have to pay. If the yield to maturity is 6%, what is the price of the bond today? And what is yield to call? How do we find out the answer for this question? What exactly is the requirement of the question? Now let us have a look at it. So, in a period of 15 years, 5 years gone, 10 more years left. So, they are asking what is the price of the bond today? Today is the day. So, face value 1,000, coupon rate 75, that is 7.5%. Coupon amount is going to be 75 rupees divided by 2 is 37.5. Why? Because it is paid semi-annually. So, how do we take up? We will have a column as term 1-20. Why 1-20? In 10 years period, you have 26 coupons and 20. Cash flow would be 37.5 and 1,000. Only for call you have premium. For maturity, you don't have that. And PV factor that you have to take up will be at 6%. PV factor or annuity factor, this you find out. In fact, it is not 3%, it is not 6%, it is 3%. Why? Because 6% per annum should be taken up as 3% for every 6-month period and arrive at the value. This is what you would have seen. They would have arrived at. Just see 37.5. 3%. I think it's not properly dealt because maybe say I have understood that 5 years later, with 10 more years left is what I have just taken it up. Going through the solution, we understand we are not here, we are very much here. So therefore, instead of 1-20, it is going to be 1-30 and this being 30. No problem. Then callable bonds are those which are called ahead of maturity, mainly due to falling interest rate. These things I have just explained. So what is yield to call? Say by doing that computation as how yield to maturity we have worked out, same way it is worked out at 3.14%. I would like you people to work out and confirm this. Annualize the yield 3.14 for 6-month period and multiplied by 2 is 6.28. Question number 3 is over. Before we could proceed to the next stage, let me find out as if you have any doubt you can raise now. Come on.
No, sir.
No. Now question number 4. One of you please read out question number 4.
ABC Limited just declared a dividend of rupees 28 per share. Mr. A is planning to purchase the share of ABC Limited, anticipating increase in growth rate from 8% to 9%, which will continue for 3 years. He also expects the market price of this share to be 720 after 3 years. You are required to determine one, the maximum amount Mr. A should pay for shares if he requires a rate of return of 13% per annum. 2, the maximum price Mr. A will be willing to pay for share if he is of the opinion that the 9% growth can be maintained indefinitely and require 13% rate of return per annum.
Say there is a problem here. Let me just check up.
So hanging like this.
There is a problem. Well, anyway, I will just share this thing now. Yeah. Third question.
3, the price of share at the end of 3 years if 9% growth rate is achieved and assuming other conditions remaining same as in point number 2 above. Note, calculate rupee amount up to 2 decimal points and the use PV factor up to 3 decimal points.
Okay. So now, how do we take up the case now? First part of the question. Say just to declare dividend is D0. Planning to purchase the share of ABC, it is likely to grow to 9%. So D0 is 28. D1 is equal to D0 into 1 plus G. D0 is 28, 1 plus 0.09. 28 into 1.09 is 30.52. Right. Then he also expects the market price to be 720 after 3 years. So P3 is 720. He is required to find out maximum amount that he would pay for the shares. If his required rate of return is 13%, I would consider this matter similar to that of a capital budgeting problem. Year number 1, 2, 3, and 3. That events are D1, D2, D3, and P3. Cash flow is 30.52, and this being 720. Here we are expected to increase with D2 and D3 based on the previous figure by applying 9% growth. Then the PV factor to be taken up at 13%. Present value of the cash flow will give you the price. This is the way you can answer for the first part of the question. Correct. Second one, what is the maximum price A will be willing to pay to the share if he is of the opinion that 9% growth will be for indefinite future. That means in the last problem, 9% growth only for 3 years. Though it is not explicitly stated that it is only for 3 years, because they've said 720 is the expected price by third year. That means we should only be understanding the gap that they wanted to hold only for 3 years, and the growth rate is applicable only for 3 years, even though it is not explicitly stated. In this problem, they have mentioned it in this fashion: P0 is equal to B1 divided by KE minus G. P0 is equal to 30.52 divided by 0.13 minus 0.09. Computation part you have to take care. Okay, my only objective in this 1 hour live program is to solve as many problems as possible. Had I taken the first question, that is the only problem I could have done. That is the reason as why I have chosen the second, third, and the fourth. Now, the next part of the question: the price of the share at the end of 3 years, if 9% growth is achieved, assuming other conditions are remaining the same as in 2 above. So they are asking us what is the price at the end of the third year. So P3 is equal to D4 divided by KE minus C. So you find out D1, D2, D3, D4 you find out, and KE and G given that you work out. And you calculate rupee with 2 decimals and PV factor with 3 decimals. And thereby you can answer the last part of the question also. Thus you see that 30.52, D2 and D3, and we are expected to arrive at the present value of the cash flows. And that way that resulted as 577.15, 763, and lastly P3, P4 divided by P minus P, 988. This solution to question number 3 is over. If you have any doubt, you can just ask. Come on. You have any doubt?
No, sir.
Okay. Now, question number 5. One of you please read out question number 5.
KLM Limited has issued 90,000 equity shares of rupees 10 each. KLM Limited's shares are currently selling at rupees 72. The company has a plan to make a rights issue of one new equity share at a price of 48 for every 4 shares held. You are required to A. Calculate the theoretical post rights price per share and analyze the change. B. Calculate the theoretical value of rights alone. C. Suppose Mr. A, who is holding 100 shares in KLM Limited, is not interested in subscribing to the right issue, then advise what should he do.
Okay, now let me start the discussion. Theoretical X rights price X equal to M into M plus R into S divided by M plus R. What is M? M stands for market price per share before rights issue. N stands for number of equity shares qualifying for rights shares. Then R stands for rights shares. S stands for subscription price of rights shares. Normally, the subscription price is expected to be lower than market price. Otherwise, instead of subscribing to the company, shareholders will buy it in the open market, the number of shares that they want to subscribe, and there is no incentive for them that shares are to be bought from the company. And if the subscription price and market price were one and the same, shareholders wanting to have additional shares, they will buy it from the existing shareholders. Money will not flow into the company. Therefore, to ensure money is coming only to the company, the subscription price is expected to be lower than the existing market price, and thereby theoretical rights price, that is post rights price, will be M into N plus R into S divided by N plus R. So by taking up that formula, we take it up at 72 multiplied by the number of shares which will qualify for one rights issue is every 4 shares, and one share can be bought at 48, the whole divided by 4 plus 1. Now let us take it up as 72 into 4, 88, and 1 into 48, 48, 336 divided by 5. It is 67.2 is the answer for the first part of the question. So, theoretical value of rights. What is theoretical value of the rights? Shareholders can either subscribe or they can sell the right. If neither of these two is carried out, they will lose their wealth. Therefore, they will normally sell the rights in case they don't have liquidity to buy additional shares. Let me repeat, when they don't have liquidity to buy the shares, they are expected to sell the rights issue. What is the theoretical value of the rights alone? That is, if they want to sell the rights, what is the price at which they can sell? So, value of a right is equal to market price minus theoretical rights price multiplied by number of equity shares. 72 rupees price is getting reduced to 67.2 per share, and 4 shares will make one right. So, I am not subscribing, my value of the share will get reduced from 72 to 67.2. For one share, I lose 4 rupees and 80 paisa. 4 shares will make one right. So 4 rupees and 80 paisa into 4 is going to be 19.20. It's going to be 19.20. Okay. Now, if I have to charge 19.20, the other person will ask, why should I pay 19.20? For which I got to give the logic. What is that? That person paying only 48 rupees per share. Now the value is going up from 48 to 67.2. That difference is 19.2. What I lose is the gain for the other person. So there is another formula that you can say is subscription, there is theoretical exchange price minus the subscription price. So 67.2 minus 48 is equal to 19.20. This is the answer for the second part of the question. For third question, suppose A is holding 100 shares in KLM, he is not interested in subscribing, then advice what should he do? He should sell the rights, where each right he will sell at 19.2. 19.20 multiplied by how many right shares that he can subscribe for. Each share, sorry, each right shares will qualify for 4. How many? 4 shares that you have? 25. So 19.20 into 25. This is the price that he should quote. 19.2 into 25. So he should charge 480 rupees. So with that, how many problems you have done? 4 problems you have done. Even when you have started 5-10 minutes later only. So with this, the weekend class for SFM is getting over.